I have noticed a lot of investors gravitating towards the highest yielding ETFs without necessarily understanding what's driving that yield under the hood. And this can come at a cost of lower growth potential over time or reduced total returns.
Today, we're talking about ETF investing, often praised for being simple, low cost, and diversified, and I won't argue with any of that. But today, we're going to talk about some of the mistakes that investors may be making while investing in ETFs that can actually impact their bottom line. Before we get started, a quick reminder, we're not providing any investment advice or recommendations. These are just really our observations to help provide you information and education around trading and investing in ETFs. Joining me today is Erica Toth, Director and Head of our Portfolio Consulting Group here at BMO Global Asset Management. Welcome, Erica.
Hey, thanks for having me on the show, Erin. Always a pleasure.
Thanks for coming. And we've coordinated our outfit. Erica and I have worked together for 17 years or so.
Always makes me feel old when you say that.
You know, I'll throw out my joke that we started in kindergarten again, which you've heard
Yeah,
sometimes.
there we go.
But we've seen it all in those 17 years and really come to sort of gather some of these mistakes that we've seen investors making or considerations that we think investors should be taking when they're trading in ETFs. So what are some of the biggest ones that you've seen, Erica? Maybe just off like high level.
Yeah, so there's a few that I wanted to unpack with you today, Erin, but I think one of the key ones would be, chasing past performance, and really important to underline that just because an ETF was a top performer last year doesn't mean it will be again this year or the next year. So, I've seen it time and time again that a lot of investors tend to pile into what's already gone up, and tend to buy near the peak. So, the fix for that, if you will, is really to focus on your long-term investment plan and not what were the winners of last year. So I like to remind people of the importance of diversification. There's one chart that I really like that I'll put up on the screen here, that gives all the major market returns over the last decade. And if you look obviously over this decade ended last December in 2025, US equities really dominated returns for those 10 years. If you look at the previous 10 years, it was actually emerging markets that were the top returning market. And some people forget also that before that, there was a lost decade for US equities. So you really want to make sure you're not putting all your eggs into one basket. I'm a big fan of the core satellite approach. For the core part of your portfolio or the bulk of it, think broad, low cost. This could be a mix of index ETFs or solid, actively managed ETFs or funds. It could be rules-based or factor ETFs. And then for the satellite positions, which will tend to be a little bit smaller in relative size, if you're tempted to include things like cryptocurrency, like clean energy, SpaceX, anything AI related, or whatever the shiny object of the moment might be. These are some sort of helpful guidelines that I would think of.
For sure. I always think of US equities right now. That was like everybody has just been piling into US equities. They've been performing so well. And, you're really missing out on a lot of different potential return opportunities. And as you said, you never know what's going to be performing in any given year. So
Exactly.
one. I think another common one is, which kind of relates to that, is trying to time the market, right? What would
Yep.
you say about that?
I would say that many, many investors, if not the majority of investors, are guilty of this. Even market professionals, really waiting for that sort of perfect entry point. And really, Erin, that can leave you sitting in cash while markets continue to move higher. That's always a risk. There's this one slide that I love that I'll put up here that shows the impact of missing just a few of the best days in the market and the massive impact that can have on the value of your portfolio. So in this example here, it's a portfolio value of $100,000, and it's the impact of missing the 5 best days, the 10 best days, the 20 best days, etc., over 25 years. And you can see how damaging that can be over the long term. So this is always a big eye opener, and I love sharing this. It's a great reminder.
We always say it's time in the market that beats timing the market. So
Yeah.
I
Uh,
100% agree with that.
And, another example that I like is, if we pull up this one here, this here is the history of bull and bear markets. This covers the S&P TSX composite returns, and it goes back to 1960. And you can see that, on average, the length of a bull market tends to be longer than a bear market, and the average gain in a bull market also tends to be a lot larger than the loss in an average bear market. So I think this is another great reminder for investors to stay the course and not to try and time markets.
Yeah, that's definitely an interesting one. And you touched on cash, and that's sort of related to this aspect of timing the market. But what do you think investor mistakes investors are making when it comes to their cash component?
Yeah, so I think being underinvested for your risk profile is another really big risk over the long term. Just to bring out an anecdote, I'm thinking of a conversation I had with a good friend of mine, maybe 5 years ago or so. And she was invested in market linked GICs, and she was in her late 30s at the time. And, I just she has decades ahead of her in terms of her investment horizon and should be majority in equities. And so the opportunity set here, the opportunity cost is loss compounding and really inflation eroding your purchasing power in exchange for that, psychological safety. So for fun, what I went and did was I wanted to compare the returns of three of our asset allocation ETFs over the last 5 years, just to illustrate what that opportunity cost could be. So again, using that round number of $100,000, if you look at ZCon, which is the conservative asset allocation ETF, the 5-year annualized return 568, ZBAL 850, and ZGROW, which is our 80/20, 11.36%. So what does that mean in terms of dollar gain on that 100,000 after 5 years? Well, essentially, if you were in the ZCon, 131,000, which is honestly excellent for a conservative investment profile, but with ZGROW, 171,000, right? So that's a big difference. And if you're somebody with potentially decades of investment horizon in front of you, um, you know, I think this is something that people need to be mindful of.
Yeah, I had a conversation on Market Insights a few weeks ago with Dale Roberts, who said a lot of people, it seems like people have kind of lost touch with their risk profile over time. So kind of the flip side of that, well, there are people that are investing too conservatively. I think there's this other group of people who are probably overinvested in equities because they haven't rebalanced and markets have been on a tear. And so it's interesting to think about that. And I think that kind of brings us to the next conversation around asset allocation. What mistakes are investors making around that?
Yeah, so I think the tendency is to spend too much time maybe selecting their investments and not actually spending the time determining, what the right mix for them of stocks, bonds, and cash is, because that's ultimately what's going to drive your long-term returns more so than security selection. There's been tons of research, time and time again, that validates that. So really, take the time to focus that you are taking the appropriate amount of risk given your time horizon and your investment needs.
And then just to layer on that, that whole rebalancing aspect too, make sure you're keeping an eye on it over time as the market shift is
Not letting things run. Yeah.
important. Um, let's talk about the other mistake sort of that ties into asset allocation, which is the home country bias.
Yep.
This is a well-known one, but what would you say around that?
So in my experience, I think investors tend to be, towards one side of the spectrum or the other. So I think a great example of, one of the extremes would be the MSCI World Index, right, which is the benchmark for world markets. And if you look at, the most recent month end of June, Canada only represented 3.34% of the weight of the entire MSCI world market, whereas the US represented 72, almost 72.5%, right? So massively skewed towards the US. So I think this would be, one extreme, investors that would try to get that sort of regional breakdown. And then there's the other extreme, which is, having, I would say, over 50, 60% of your holdings in Canadian stocks or bonds, right? So um, in practice, like I would say most of the investors that I've talked to, they might be somewhere probably between the 25% and the 50% mark in terms of Canadian holdings. And there's good reason for that as well, right? There's familiarity with the overall market here in Canada, but there's also the tax efficiency, for example, of collecting Canadian eligible dividends for investors that are more income oriented. So there's different things to consider when making that asset allocation decision on a regional level.
For sure. I want to switch gears a little bit and talk about yield, which I think is very popular right now too. With the rise of covered call ETFs, we're seeing some investors seemingly chasing yields. So what's something to consider there?
So, Erin, I have noticed, a lot of investors gravitating towards the highest yielding ETFs without necessarily understanding what's driving that yield under the hood. And this can come at a cost of lower growth potential over time or reduced total returns. Very popular over the last several years have been these covered call ETFs yielding double digits. And I think it's important to understand the methodology of that covered call provider. Our approach at BMO with the covered call ETFs is really to focus on the total return. We are managing quite actively those options positions, whereas some providers might be writing the calls at the money, or they might be using leverage. And these are things that can in the former case, reduce your returns, right? If you're writing the calls at the money, and in the case of taking on leverage, exacerbate your potential downside during downturns, right? So these are things that you want to be aware of. The other thing I'll say, Erin, even within the BMO lineup, if an investor is looking at yield and drawn to yield, a good illustration would be ZWB, which is the covered call Canadian banks ETF, versus ZEB, which is the equal weight Canadian banks ETF. And what I would caution investors is, if you don't need the additional yield, you're typically going to be better off uncovered over the long term, right? The covered call ETFs are designed for investors that are looking for a higher level of monthly cash flow and are looking for a tax efficient way to do that, right? So the options premiums within ZWB are taxed as capital gains. However, so just to get back to the main point there, if you have the choice between ZWB and ZEB, if you're a long-term investor, going back to the example of somebody with a couple decades of time horizon in front of them, and if you're a buy and hold investor, you're probably better off using the ZEB. If you're retired and you're looking to have a consistent source of tax efficient monthly cash flow, ZWB would allow you to do that, and you're still participating in a good amount of the overall growth potential there because of the way that the options are managed.
It's funny because this exact example came up 3 different times, 3 different questions at our Toronto ETF Investor Day. I compared ZEB to ZWB, and ZWB underperformed, and we had it 3 separate instances. So there's definitely more education that needs to take place on, how you need to start with your objective. And what is it you're looking to get here? Are you looking to get cash flow? Or are you looking to get growth, and understanding the trade-offs that you make when you invest in a covered call ETF. But taking that a step further, even within covered call, if you've decided you want that cash flow, even within the covered call ecosystem where there are hundreds of ETFs available in Canada, you can still compare based off of performance, and some ETFs are going to do better from a total return perspective than others because of the option writing strategy. They're able to catch more of the upside. So even taking it a step further, there's more education that needs to happen around it.
Absolutely. And we're very focused on the total return approach at BMO. So not only providing that boost of yield with the covered calls, but also providing as much upside potential as possible.
And I think with the banks example, there's other, there's so many products that invest in the big six banks, and having the ability to really cleanly compare those is interesting across products.
Absolutely.
What about fees? ETFs are known for being low cost, but investors still might not be considering the whole picture. So talk to us about that.
Erin, this is a huge topic, and it's about to get even bigger at the start of next year. So one thing I'm going to preface my answer with here is that in January, investors are going to be seeing a whole separate line item on their brokerage statements when it comes to fees. So there's new fee disclosure regulation coming into effect. So they're going to be listing on the statements not only the MER of the funds and ETFs that you're holding in your portfolio, but there's also going to be a new component, TER, which is trading expense ratio, and that's what the portfolio manager's trading costs are to run that product. Okay. And these are going to be amalgamated into a single line item, which is going to be called FER, or fund expense ratio. So basically MER and TER together. So previously, TERs were not disclosed as a separate item on investment account statements. So that's coming down the pipeline. And fees are also going to be disclosed both as a dollar amount for each investment held, as well as a percentage amount. So there's more fee disclosure coming up, which ultimately I think is a good thing for investors to have more information on the fees they're paying. But one thing I really want to highlight and I want to stress is that for investors, you want to make sure, as a part of your regular due diligence process when you're evaluating different ETFs, that you go on to the fund provider's ETF facts document, which is the regulatory document. So this document goes beyond the monthly fund profile or fact sheet, and you will find those exact disclosures on there. So to help you make those decisions, you want to make sure you're getting the full picture of what you're owning in terms of the costs of owning that ETF. So just to give you an example, I've come across a few ETFs listed in Canada, one in particular that advertises a 0% management fee, which, I mean, sounds great, right? But then when you go and verify that ETF facts document, 2.5% MER and an additional 10 basis points of TER, which is a far cry from that 0% management fee that you see on the landing page of that product page. I've also seen MERs of 4% when the management fee listed, on the product site is under 1%. So these, I would say this is a must for investors using ETFs, as you want to really drill that into your process when you're first evaluating the ETF and deciding whether to buy it or not. Make sure you're going to that ETF facts regulatory document. This document will also show you the average bid-ask spread. That's typically on the top right-hand corner of the ETF facts regulatory document, and that's going to cover the 251 trading days, so all the days the market was open in the previous year, up to the publication date of that document. So it shows you the average spread, and it's also helpful in comparing costs of ownership from one ETF to another.
Awesome. Thank you for that. That's a very important consideration.
Yes. Sorry to interrupt you there. One other thing that just popped into my head, Erin. Fees are not everything, right? While they're important and while they are going to be under more and more scrutiny going forward, they're not absolutely everything. So you want to consider costs, but you also want to consider performance, you want to consider risk-adjusted returns, and you want to consider whether that ETF is a fit for your investment objectives. Those are the last points I'll make on the fees. Back to you.
For sure. Thanks for that. Okay, moving on to our next mistake or consideration, that is potentially investors not understanding the currency exposure or the impact of currency on their portfolios. So this is a good one too.
Yeah, so I think sometimes investors might not realize whether an ETF is currency hedged or unhedged, and those exchange rate movements can really impact returns over time. So, a few things that I would suggest that people consider when they're deciding, what currency option of an ETF to go with. Firstly, would be the time horizon of your investment. If it's a long-term buy and hold type position, or is it more of a short to medium term, more tactical position? If it's a long-term buy and hold, um, currency tends to have less of an impact and you might not get as whipsawed in terms of your returns. If it's a short-term tactical position, then investors might just want to consider, okay, going with the pure exposure, stripping the currency out of the equation, and going with the Canadian dollar hedged version. Secondly, would be your outlook on the particular currency for the exposure that you're buying, right? So if your outlook is that the US dollar is going to weaken, then perhaps Canadian dollar hedged, or in the case of international, a hedge to CAD for an EFI exposure if you think the Eurozone currencies are going to weaken, for example. Um, the third thing that I would highlight, Erin, is correlations with equity markets. So we talked a little bit about the US dollar. The US dollar over the long term has tended to be negatively correlated with equity returns. And in years when equity markets have sold off, historically it's been helpful to be unhedged for the US dollar exposure, as that's added a source of diversification. If we're talking about the euro, historically, it's been the opposite, so positively correlated with equity markets. So I have a chart here that I'd like to share on the screen that illustrates just that. Another thing you want to consider is the cost of hedging. So this is driven by the interest rate differential between the countries involved. This will not be part of the ETF's MER or TER. You'll actually see it in the performance of the ETF. So in other words, performance is net of any hedging costs. When we're talking about currency hedging costs, Canadian to US dollar pair is very, very liquid. It's a very heavily traded currency pair. This would be the least costly from a hedging cost perspective. EFI, slightly more expensive to hedge, more countries involved. But at the scale that large ETF providers are doing it, it's going to be, a lot less expensive to get that hedge, right? Um, Emerging markets, typically you won't see hedged to Canadian dollar options because there's not enough liquidity in many of those currency pairs. So typically you won't see EM hedged to CAD available.
Yeah, that would be a complicated one for sure.
Maybe
I
one
think,
last point. Sorry.
yeah, no, go ahead.
Maybe one last point I'll add there is the asset class. So for fixed income, for example, the currency pair itself might be more volatile than the underlying bonds. So a common approach is to buy the currency hedged version for fixed income. That said, we do offer hedged, unhedged, and US dollar denominated fixed income purchase options. So the investor has the ability to choose the right exposure for their needs.
That's great. Yeah, the ETFs have really brought a lot of flexibility to that decision-making process, which is amazing. Let's bring it full circle to emotions, because I think this is probably the most important factor when it comes to ETF investing. So letting that mistake of letting your emotions drive your decisions, I think that's a good one to close with.
Absolutely. And I think this can potentially be the biggest mistake of all. And, the levels of fear during market downturns, and on the flip side, greed during rallies, this can lead to a lot of poor investment decisions, a lot of unnecessary trading. One thing that I think back to in particular, to share an anecdote, is, when COVID first gripped the markets. I don't know about you, but I remember exactly where I was and what I was doing when the TSX was down 14% in one
What were
trading
you
day.
doing? Where were
I
you?
was I was seeing investment advisors in Fredericton, New Brunswick. And when I think back to that day with the TSX being down 14% in one day, it was the biggest one day drop that the markets had seen in 80 years. Like that's a massive move. And I just remember emotions were really high. There was a lot of headlines in the news about how we were going into the next Great Depression. We've never seen a shutdown across the economy of this scale. And there was a lot of panic, right? I think there was a lot of people that were tempted to panic sell, and historically, this would have been, one of the worst decisions you could have made. We also saw
I think
fear about the
advisors' role changed to a psychologist in that
absolutely,
moment, right?
absolutely, and that was a really, really tough thing to go through, right? People were seeing their life savings, the amounts just melt down, and we tend to have this anchoring bias, right? We anchor the value of our portfolios to the highest watermark that it's achieved, right? So when you see downturns in the market like that, it can definitely be unnerving. It can be discouraging, but it brings me back to the reminder piece that I shared earlier is that market movements, gyrations will happen inevitably. There's this great piece that shows, every year going back to, I think even the 1950s or the 1940s, what drove the panic in the market in that particular year. And then going back to this other piece where you could see that over time, the the ups in the markets outweigh the downs, and that you really have to just learn to stay the course and keep a cool head and stick with your investment plan.
Very good. Thank you so much, Erica. I think, yeah, you nailed it. It's about having a plan and sticking with the plan and understanding that the markets are going to move over time. But if you have that long-term goal, then the best thing you can do is likely to stay put. You touched on bid-ask spreads, and I think that comes down to sort of trading execution and what investors should be thinking at the time of placing the trade. And there are some considerations and mistakes that investors are making around the timing of those trades, and walk us through what they should consider there, Erica.
So, really good example of this was actually last Friday, which was the 4th of July, Independence Day. US markets were closed. And in cases like this, bid ask spreads continue to be significantly wider. So, if you were trying to trade, for example, ZSP, ZUE, ZUQ, all of those hold US equities as the underlying investments, you would have been able to trade it. But when you go to trade it, you would see that spread really widen out. So by waiting till this past Monday when the U.S. market was open, you would have saved significantly on the execution costs there. So Erin, I'd also say just quickly, this is also really relevant when we're talking about international equities, and super relevant this year again because international equities is one of the strongest areas of inflows in the ETF space again this year. If you're buying an international developed markets ETF such as ZEA, ZDM, ZDH, keep in mind that close to 60% of the underlying portfolio of EFI exposures is European markets. And on average, they tend to be about 7 hours ahead of us. So you want to get your international equity trades in by around 10, definitely before 11 a.m. Eastern time, because you'll tend to see spreads widen out, especially as you head into the afternoon and those underlying markets are closed. So I always like to remind investors of that, to trade when the underlying markets open if possible. Now, just for fun, the remainder of the EFI exposure is developed Asia and Pacific markets, and those actually don't have any overlapping opening hours with North America, but the bulk of the portfolio is European markets. So something to keep in mind to get best execution on those trades and keep your costs down.
Perfect. Yeah. And of course, the market makers there to do their best to get the right price, but that's going to make everybody's job easier if you trade when the underlying markets are open. And then we also always say avoid the first 30 minutes and the last 30 minutes of the day, right? When the market makers are working to get that price. So great explanation there. Thanks, Erica. Thanks again for sharing all your insights. We made it through our top 10.
Thanks so much, Erin. Always a pleasure chatting with you.
That's all we have for today. Thanks for joining us, and we'll see you next time. Bye for now.